Hi there. So today's content, I want to talk about capital gains. But before we dive into this article specifically talking about how to avoid capital gains, I want to kind of revisit. If you've seen any of our videos or any of our content, you've heard us talk about on numerous occasions asset buddy system, the 3Ds. You've heard us talk about as a business owner, you need to approach things differently, and many times CPAs, tax professionals, financial advisors lump you as a business owner into the rest of their types of clients that may be more W-2 wage based. Now, I'm not saying that's a bad thing. I'm just saying that you deserve a little extra planning and expertise because you have the tax code to your benefit. It's on your side. And so to be able to be lumped with that group and not have a professional look not just as you as individually, but also as your business and how the two intertwine with each other is very important. And the reason why I say this is that IRS bases this comment on what they do, right? So if you've seen any of our videos or content, you always understand and hear from us that we're going to talk about things from based on the IRS's viewpoint. So let me give you an example. Every taxpayer files a 1040 personal tax return. Absolutely, you included as a business owner. But is that all you file? No, you also file a business return. Do individual taxpayers that only have W-2 wages file a business return? Absolutely not. So right from that get-go, the IRS is saying, hey, by the way, you have another asset, a business, that we'd like you to file a separate tax return, whatever your business entity structure is. So if it's a partnership, it'd be a 1065. If it's a C Corp, it'd be 1120. If it's an S Corp, it'd be 1120S. Now, if you're an LLC, you have different ways of choosing how to be taxed as an LLC. Could be as a sole proprietor, which would be on the Schedule C on your 1040 personal tax return. I urge you to get away from that. And the reason being is that that's the number one audited schedule on the 1040. And so as an LLC, you have the option to be taxed as a S Corp, a C Corp, as well as a multi-member or a partnership. So when you look at it from the IRS's perspective, if you have to file a separate tax return for your business and your entity, you are different and you should be treated as such. So what I'm going to do is I'm going to go through this article that talks about how to avoid capital gains tax. Now I know they use the term avoid to get you to click on the article. Now we're going to redefine that because they redefine it in the article immediately in the very beginning. So I'm going to minimize my screen here and let's talk about that. So how to avoid capital gains tax. Okay, this was December 2nd. We all know that only two things in life are truly certain: death and taxes. But just because taxes are an inevitable part of our society doesn't mean you can't limit how much you pay to Uncle Sam. Notice they went from avoid to limit. Okay, so that tells me that the word avoid is to get you to click on the article. Take a look at it. Okay, now taxes on capital gains can eat up a significant portion of your earnings each year. Maybe, depends on your assets, and they'll talk about this. Here are some common strategies to avoid capital gains taxes on how you can implement them. It's wise to consult a financial advisor, blah, blah, blah. Now, let's talk about this. A significant portion of your earnings each year. Now, one of the things they're going to talk about is the difference between short-term and long-term gains. Well, the 15% long-term cap gain or 20% short-term cap gain. Now, these may be changing at the time of this recording. We are in the process of current administration making some adjustments. And so those numbers, those percentages may vary or change. When you view this, that may have already occurred. Now, that being said, is that the only time cap gains kick in is when you sell a asset, which it talks about here in this article, which we'll discuss and address that. So I want to make sure it's very clear that cap gains are not a part of your tax equation unless you sell a asset. Okay, what's an asset? Anything that creates income. What are examples? Stocks, bonds, mutual funds in an individual account. Okay. Let's say, meaning that it's not a retirement account because those are deferred to later. And we'll talk about that. Real estate, you sell a piece of property. If it's not your primary residence, it's an investment property, there's going to be cap gains. If it's your primary residence based on current tax laws, is that if you're married filing joint or you're a married couple, you have a certain percentage of your gains that are deferred from cap gains. Anything above that would be capital gains tax, okay? And then you sell your business, there are capital gains tax on that as well. So other than that, everything else is pretty much a ordinary tax for an individual. And then if you're a business owner, the only time you really are affected by business corporate taxes is if you're a C Corp, and based on those rates that are based on profit. Okay. If you're a pass-through, meaning an LLC, an S Corp partnership, those profits from your business or losses from your business pass down to your individual tax return. All right. So let's go dive into this. What are cap gains? Well, when you own an investment or an other asset, such as real estate, by the way, the word investment is asset. Okay. Why would you invest in something that does not create growth that it potentially turns into income? Right? So an asset is an investment. You're investing in assets. So just want to clarify that, such as real estate, land, business or stocks, for example, and later sell that asset for a profit. Okay. Now here's the thing. Cap gains, how do you offset? And they'll talk about this later on, is maybe you offset or you sell a asset that actually has a loss to offset other gains. So you have to make that assessment when you go through this process. The tax that is then levied on the profit portion as your sale is called capital gains tax. Depending on how your gains are classified and your total taxable income for the year, your cap gains rate may vary. This percentage may be as low as 0% or as high as your ordinary income tax rate. Okay, so how to avoid capital gains tax? Well, handing over a chunk of your profit can be painful. Sure, any kind of tax is painful, right? You work hard for this money. You want to be able to keep as much as you can. So choosing long-term investments, meaning, hey, don't sell the short term because you're going to end up paying 5% more percent. Well, depends on your gain, right? If it depends on the asset. So what they're saying here is, as best as you can, extend the ownership of this asset beyond a short term, so it enters into a long term. By considering long term, a year or longer, you get a better tax benefit than if it's short term. But in certain situations, you may have an asset that just appreciated, and it may make a lot of sense to offload, to sell that particular asset, because it may not reach into long term to your profits. It may dip and drop. So, and I'm not saying, buy low, sell high. I'm not talking about that. I'm just talking about looking at a particular asset that makes sense to unload and take advantage of the appreciation on that. So if you do that, you are going to be at a 5% higher tax rate, and that percentage, that law may change with recent administration. But let's just for now talk about a 5% difference. Is that big of a deal? Depends on your gain, right? It depends on how much money you're making off that asset. So I don't want to put so much emphasis on it needs to be long-term gain. Okay. All right, so let's see here. Okay, so you can take advantage of deferred retirement plans. So let's talk about deferral. So all tax strategies, tax planning strategies are deferral strategies. To the point of the article, you're always going to pay the tax man. The tax planning is all about when and how do I want to pay the tax man. So deferring is a strategy to allow us to determine when. And then when you get to that when, you got to understand how you're going to pay that tax man. Okay, so retirement plans are a very popular strategy, but for business owners, I don't find it to be a very popular strategy unless you look at the tax savings as part of a planning strategy, because when you're deferring and you're building and growing that asset, supposedly, you're building and growing that asset in the stock market. Well, your biggest risk is your business. So most business owners we work with are not big fans of stocks, bonds, mutual funds just because of the uncertainty of it. I understand that. I do. And as a fiduciary, a Series 65 advisor, having our own RIA, we understand the significance of that as well. And so, but as part of a plan, it may make sense to have that tax deferral strategy, not from the deferral aspect, but from the front end tax planning. So depending on what we're talking about in the overall plan. So again, this is not advice by any means. I don't know you, whoever's watching this, but just saying when we work with our clients that engage us, we do look at this as an option. But many times a tax deferred retirement plan is a last option, not a first option, like many advisors say this is the first option. Okay. Now, the reason being is that the exit strategy, when you're looking at any type of asset, the whole point of this article is capital gains. That's the exit strategy, right? So when you enter into an asset, an investment, you want to understand what the exit strategy is, or exiting of the consequences of getting into it. So a deferred retirement plan, yeah, I'm going to get a tax deduction right now. I'm going to grow my asset tax deferred, meaning I'm not going to pay any taxes on the gains until I start taking it out. Well, retirement plans are not taken out as capital gains tax. They're taken out as ordinary income tax. And the current administration is talking about having caps and limits on how much you're allowed to have in your retirement plans. And if you have more than a certain amount, they're actually going to create an excise tax. Now, if you ever read my book, Economic Termites, over right here, when we talk about laws and regulations, we do talk about surcharge, excise taxes on retirement plans. And lo and behold, that was published 2 years ago. Lo and behold, guess what they're talking about? Now, they're also talking about those with higher balances in retirement plans are going to have to accelerate that money in the required minimum distributions, or RMDs. Okay, so, and have an excise tax on that. So there's a lot of talk. So the point is that this asset class, retirement plans, is an asset class that is not a capital gains tax. It's an ordinary income tax. And so there's a big difference. So it may not be a viable strategy, which is why I'm bringing this up, is because they're saying take advantage of it. But you're saying, hey, how do I avoid capital gains tax? I go into ordinary income tax? Does not make sense. This is why, as a business owner, we need to look at this and understand what people are saying and how it's referring to. Now, you can go to a tax-exempt Roth IRA account where you pay the tax up front, but the money in there is tax deferred, but it becomes tax-free at the back end. But there's income limitations, there's contribution limitations. We have other strategies, especially using cash value life insurance, using real estate, using what we call the asset buddy system in the 3Ds, to address not the Roth IRA, but to address how you can, from the very beginning, middle, and end of your tax and your asset plan, not have any taxes and defer those taxes to when? Probably estate planning, meaning death. Okay? So anyways, I digressed. I apologize for that. So how do you offset? The next one is offset your gains. This is what we're talking about. This is what we do with our clients, is that we look at the whole picture, the entire assets, and we look at, hey, your business, we look at your real estate and other assets, we look at your cash value life insurance, we look at your retirement plans, we look at all your assets and say, okay, how and when is the best time to offset gains using tax planning? Okay, that's what we're talking about here. It's not talking about selling off assets. It's talking about utilizing assets, because a tax savings, think about it this way. Tax savings is your rate of return. The appreciation and growth on an asset is a rate of return as well. But many times your greatest rate of return is asset or tax planning. Okay, so for example, today, if we were to minimize your income need, and your profit from your business, we're able to tax plan away, and you're in a 37% federal bracket, tax bracket, that's a 37% rate of return. Okay. Now we have a tax bracket management video that talks more specifically about this, talking about our income funnel and utilizing from a tax savings what that could mean to you. But think about it this way: if you sell that asset, it's a cap gain tax. Okay, so we need to make sure that that asset has appreciated a significant amount, to when you do sell that asset, that the cap gain is a lower cap gain, but how do we offset that? And so that's where we look at other assets and looking at current assets and what we want to do. So remember, you don't file or pay those taxes until you file your taxes, right? Let me go back to the video. So this is very important. You sell an asset in July. Well, you don't pay the cap gain in July. When do you pay the cap gain? When you file your taxes. So you file your taxes the following year, March and April. If you file an extension to September, October, is when you decide to file your tax return, and it indicates the amount of tax you pay. You still may not pay the full tax. You may decide to go into a payment plan with the IRS and or state. Okay, so that's part of the planning process as well. So what happens if you sell an asset? It does create a cap gain, but all of a sudden you're able to utilize that asset into those gains into another asset that actually creates a tax planning opportunity, that creates tax deduction that offsets that cap gain to where it's a zero, or you actually get more tax savings, and you have the opportunity to reduce your taxes all over again. So I want to make sure that that's clear, because a lot of these articles don't talk about it. You don't pay your taxes until you file your tax returns. Okay, so if you sell an asset again in the year, but you utilize the proceeds from that asset, then we may be able to tax plan that tax gain away by utilizing the proceeds of that sale. Okay, let's see here. Okay, and so if you hold a number of different assets, which every business owner we work with does, and every business owner we work with, we encourage multiple assets and diversifying assets, because the tax code, the IRS, looks at each assets differently. So an overall plan, that's our asset buddy system, we can create a tax and mitigate those taxes a lot of times very close to zero. Let's see, application losses, allowing you to avoid portions of your cap gains tax. For instance, if you have one investment that is down $3,000, another investment that is up $5,000, selling both will reduce your gain, and you would be subject to capital gains tax on the difference of the $2,000. Okay, so now they use low numbers because this article is not specifically to you as a business owner, it's specifically to traditional wage owners. Okay, so that's why I wanted to record this article, is because if you're watching this, you're a business owner and you need to focus on you as being a business owner and look at things that are being reported to us in the public from a business owner's perspective. So not everything is going to pertain to you. So we need to make sure that you focus on that aspect of this. So thanks so much for attending. Hopefully this this article was beneficial to you in the explanation and kind of giving you an idea of how to view from a holistic perspective decisions you make in the time frame that you have that. And if you're interested in economic termites, you're interested in more information on our asset buddy system or the 3Ds and some of the information and the things that we talked about in this content, feel free to add a comment. Go ahead and subscribe to our channel, reach out to us and email and say, hey, I saw this article, I'm really interested, or this video, I'm really interested in learning more. I'm a business owner and I have some needs that I'd like to have a conversation. We'd love to talk about your situation. We're not going to charge you for that. It's just a conversation to get each other to know each other and see if there's a good fit. Maybe there's not, who knows? But if you like this information, please, again, give us a thumbs up, subscribe to this, add some comments in the comment section, send this and share this content with other business owners as well that you think this would make sense for. Thanks so much. My name is Robert Wolf. I'm with Terra Firma Business and Financial Consultants. I'm an asset coach and tax strategist.